Hey, welcome to Retirement Made Easy. Today I wanted to talk about one of the biggest investment mistakes that I see people making over and over again, especially the people that are investing inside of a 401k, whether they're still working and approaching retirement, or after they're retired, maybe they still have their money in a 401k and they're in the decumulation phase, where they're in the spending mode or spending phase of their life. You're not going to believe how costly this mistake is over 5-10 years and how simple a mistake like this is. And I see this, just like I said, over and over again. Now, the point of me doing this video is so you can learn and maybe avoid a mistake like this. They say a smart man learns from his mistakes, but a wise man learns from the mistakes of others. I'm hoping you can all be wise men and women after watching this video. So let's get into this. One of the biggest mistakes I see as far as investments. Okay, so let me paint the picture for you to start. We've got a 62-year-old woman named Linda. And Linda retired with $500,000 in her 401k at the start of 2015, so 10 years ago. And they told her, hey, you can take a 4% withdrawal. And so that's what she planned on doing. And in her 401k, she told them, hey, I want to keep my money conservative or safe. So here we are 10 years later in retirement. And you're going to be surprised kind of where Linda stands at this point, just 10 years into a 30-year retirement, and her progress that she's made or a lack thereof. Like I said, so Linda retired January 1st of 2015, and inside of her 401k, they have her in the U.S. Total Bond Market Index with 100% of her money. She was told this is a safe option. So this is the start. We've got the total U.S. bond market index here, and Linda's got 100% of her money in that, and $500,000 is what she started with. And so we're going to start 2015, and we're going to run through today here in July of 2025. And so her starting value is $500,000. She's withdrawing 4% a year, which she's taking on a monthly basis. So 4% of $500,000 is $20,000 per year. And per month, that is $1,667. We're going to say, okay, her costs are adjusted for inflation, and then she's taking these withdrawals on a monthly basis. And 100% is in the U.S. Bond Market Index. So we'll see how Linda is doing here 10 and a half years later. So starting with $500,000, starting the, end of 2014, first part of 2015, kind of going down. She is in spending mode, and the returns are not keeping up with her spending. So over and over, and we keep going down, and here we are in 2025, and her $500,000 with all the spending is now worth $329,000. But if we adjust that for inflation, it's really worth $239,000 just 10 years later. She's got less than half of her starting value 10 years later. Well, why is that? She's been taking the 4% withdrawal every year, and the last 10 years, the U.S. bond market index just has been underperforming the historical averages. So we started out in 2015, it was up 0.3. Then in 2016, it was up 2.5%. The next year, it was up 3.45%. And then in 2018, it was down slightly, 0.13. With Linda spending her 4% a year, and the returns have just been pathetic out of the U.S. Total Bond Market Index. You can see if I go down here, the last 10 years, the average is 1.62%. And if we go down a little bit more, geometric mean, which is really the average, 1.46% since the first part of 2015. 2015. So Since she's been retired, she's been, again, withdrawing 4% a year, and it's only been earning her on average per year 1.46. This is a recipe for disaster. If these kinds of returns continue at this pace, unfortunately, Linda's gonna run out of money at some point. It's inevitable. Starting with $500,000, you can see 10 years ago where she stands today, inflation adjusted, right under $240,000. And she's still got 20 years left of retirement if she makes it to average life expectancy. So this is one of the biggest mistakes that I see over and over again. People say, well, I want to be conservative with my money. And so they're told, or they're put in the US bond market index. And again, this analysis does not include any type of fees or anything like that. This is just purely hypothetical. If Linda put all of her money in the US total market index, total bond market index 10 years ago when she retired, where she would stand today. So it does not include fees of any kind, management fees or anything like that. So that would actually make the results worse, as you can imagine. So looking back, the 3-year average is 2.4%. The 5-year average is actually negative, and the 10-year average here is 1.62%. So it just, again, big word of caution, and I see people making this mistake over and over again. If you're spending 4%, 5%, whatever that happens to be, you still need your money to be growing and surpassing what you're spending just to stay even. And in Linda's case, she went this route, or was told to go this route, this supposedly conservative option inside of her 401k, and her results were not what she was anticipating. And so that it brings another point. Sometimes these conservative options, like a US total bond market index, they have their own risks that a lot of people don't understand and don't talk about. And I know a lot of listeners are probably invested in these target retirement date funds. And a good portion of those, a lot of times, many instances, is invested in the US total bond market index. So again, word of caution, and I see this over and over again. People inside of their 401ks either think it's being professionally managed by the 401k provider, or they think it's not their responsibility. And it is. I'm telling you, it is. You are in the driver's seat when it comes to not only your retirement, but also your 401k and how your retirement savings are positioned. Because this is just an example of somebody that started retirement 10 years ago and is not having the retirement that they envisioned, starting with $500,000. And at this point now, inflation adjusted is down to $239,000, less than half of what they started with just 10 years later. So the question then would be, if you were in Linda's shoes, okay, now that we know we've got $239,000 left, how long is that gonna last? Is it gonna make it for the next 20 years? And that's where people get really concerned that, hey, their money's not gonna last as long as they do. And it's oftentimes, it doesn't last because of silly mistakes that people make, just, I guess, unknowingly. Maybe the money's in a 401k and they don't have a keen eye on how the money's actually working for them. So I would encourage you to do something different and to really stay focused on how your money is invested, how it's going to be working for you, not only in the near future, but also long term. Because a strategy like this is, like I said, a recipe for disaster, and I don't want you to make a mistake like this. Again, very simple, but really telling of the long-term impact of investing your money like this. I hope this episode of the Retirement Made Easy YouTube channel has been helpful. I'll see you next time, and remember, always dream big. Hello, I'm Greg Gonzalez, founder of RetireStrong Financial Advisors. If you want to see more videos like this, please like and subscribe. And if you want to learn more about how we help people plan for a successful retirement, visit our website, retirestrongfa.com.